Are you a business owner trying to figure out financing for your home purchase? If so, you've come to the right place. I'm Thomas Ross, a top producing loan officer here in Texas with over 5 years of experience and hundreds of families helped. In this video, I'll be explaining the home loans available to you as a self-employed business owner, ranging from the more traditional, conventional, and FHA loans, all the way to the unique bank statement, 1099, and profit and loss loans. For conventional and FHA loans, you're required as a business owner to have been in that business for at least 2 years. More often than not, the income that we're allowed to use for your loan is going to be based off your last 2 years of filed tax returns. There are some instances where only 1 year of returns is required for conventional loans. Now here's the key with these traditional loans. Your income is based off the net profit on your tax returns. And the thing is, if your CPA is doing a great job, usually that net profit is a lot lower than what you're actually taking home each and every year. So too many write-offs usually means no approval with these more traditional loans. That being said, there are a few things that we can add back to your net profit. These are your non-cash expenses like depreciation, depletion, and amortization. Now, the benefits of conventional and FHA loans is that they do offer lower down payments and slightly lower interest rates than the other options we're going to talk about. So if you do fit in this box, it's probably best that you use them. But for most self-employed business owners, they don't fit in the box. As we move outside of that box, the first loan type we're going to talk about are bank statement loans. With a bank statement loan, we don't look at your tax returns at all. So no matter how many write-offs you had on there, or even whether you posted a loss, it's not going to count against you. You still, however, need a 2-year history of owning this business. We're going to add up the income for your last 12 months of bank statements as a business. And then we'll apply a standard expense factor. This starts at 50% to account for the expenses that it takes to run your business. Now, if your business doesn't actually take 50%, we can get a written letter from your CPA indicating that and reduce the expense factor we have to use. You can clearly see how using the income from the bank statements is going to set you better off than using the income from your tax returns or writing off to not pay Uncle Sam. 2 things to note here. You do need at least 10% down payment to use a bank statement loan, and the rates generally are a lot better at 20% down. Hey, if you've been watching this, you're more than likely a business owner. Leave me a comment below and let me know what your favorite book is that's helped you build your business. Moving on to an even easier loan type, especially for contractors, is the 1099 loan. With the 1099 loan, we look at your last year's 1099 or an addition of all the 1099s you received and apply only a 10% expense factor. You can see how your income here is going to look a lot higher on paper. 1099 loans are great for gig workers, freelancers, a lot of people in the construction industry, or especially real estate agents. These loans are going to have the same stipulations as the bank statement, where as a minimum we need 10% down, and the rates are a lot more attractive at 20%. Now, if those first 2 fail, let's say you had some cash flow issues, so the bank statements didn't work. Our next route is to look at a P&L, or profit and loss loan. With a P&L loan, we look at your last year's profit and loss statement. This does have to be CPA prepared by the same CPA that did your prior year of taxes. We then get to use the net income from this P&L towards your mortgage qualification. In this case, we only have to look at the last 2 months of your bank statements, and again, no tax returns required. The biggest thing I want you guys to get from this video is that as a self-employed business owner, if you're being told no elsewhere, let's have a conversation. One of the biggest concerns about using unique financing methods is that your interest rate is going to be super negatively impacted. And that just really isn't the case with these. Let's do a quick rate comparison. This video is being recorded in late February of 2025 with an average credit score of 740, a $500,000 purchase price, and 20% down payment. On a conventional loan, you'd be looking at about 7%. On a bank statement loan, you'd be looking at about 7.375. The difference between these two is $101 a month in your payment, or just over $1,200 a year. But here's the thing. If in order to qualify for that conventional loan, you had to claim an extra $50,000 of profit for the last 2 years, how much extra would you pay in taxes? Well, at a reasonable 22% marginal tax rate, you'd be looking at $22,000 extra that you paid in taxes to not pay $1,200 in interest. Seems like a no-brainer to me. To conclude, if you're a self-employed business owner looking to finance some real estate, we're first going to look at the traditional products versus your tax returns and see if you fit inside the box. But if you don't give up hope, because there are non-traditional options that we'll explore for you that might make more financial sense. If this sounds like you, click the link in the description to schedule a free consultation with me to discuss your home purchase.